Today we're going to focus on the difference between the balance sheet and the income statement, profit and loss statement, or P&L. The balance sheet can be understood as a snapshot of a company's financial situation at a specific point in time. You can think of it like taking a photo of the financial position of a company, which gets updated only when the next balance sheet is published. Typically, the balance sheet is prepared and published annually as part of the year-end financial statements. However, larger companies, such as publicly traded ones, often publish their balance sheets more frequently, on a quarterly basis, for example. The financial position is reflected by the assets on the left side of the balance sheet and the liabilities and equity on the right side. The two sides of the balance sheet are always balanced, so you can imagine the balance sheet as a kind of scale. On the asset side, you'll find items such as fixed assets, which include production machinery, and current assets, which include inventory or finished goods. On the liability side, you'll find items like equity, the company's own financial resources, and liabilities, which include borrowed funds such as loans. The asset side, therefore, shows the use of capital, what the financial resources were used for, such as purchasing a manufacturing machine. The liability side, on the other hand, shows the source of capital, where the financial resources came from. These could either be internal resources, equity, or external resources, debt. Equity is also calculated as the residual value when assets are compared to liabilities, which is why equity is referred to as a residual value. Moreover, the equity position reflects the company's profit, as the net income or net loss is a subaccount of equity. That's the balance sheet. Let's now move on to the income statement, P&L. The income statement records transactions that affect the company's profit and loss. These are referred to as profit-affecting transactions and include all transactions that increase or decrease the company's profit. Examples include the sale of goods, increasing profit, or the loss from selling defective machinery, decreasing profit. The income statement distinguishes between revenue, positive impact on profit, and expenses, negative impact on profit. This means the income statement explains how the profit or loss for a given business period came about. To ensure this is accurately tracked, the income statement is essentially reset for each new period so that revenue and expenses for each period can be clearly determined. The balance sheet, on the other hand, is not reset for each period since it always represents the company's overall financial position at a specific point in time. Got it so far? Good. Now let's clarify the relationship between the balance sheet and the income statement. It's simple. If a company generates more revenue than expenses in a period, its profit increases, and so does its equity. Since both sides of the balance sheet must always be balanced, the total value of the balance sheet increases in this case. Conversely, if a company incurs more expenses than revenue, its profit decreases, and so does its equity. This reduces the total value of the balance sheet. Perfect. That's the theory. Let's now look at a small example to better understand the balance sheet and income statement. The accountant, Miss B, has received a set of tasks via email from her supervisor. She must decide for each task whether to refer to the balance sheet or the income statement to complete it. Let's begin. The first task reads, "Please record the revenues." To record revenues, Miss B only needs the income statement since revenues are only reflected in the income statement. Therefore, Miss B correctly assigns this task to the income statement. The second task reads, "Please determine our most recently published debt level." Since the debt level is part of the company's liabilities, which are reflected in the balance sheet, Miss B correctly assigns this task to the balance sheet. The final task reads, "Please prepare the year-end financial statements." To prepare the year-end financial statements, all balance sheet accounts must be closed, and the total revenue and expenses in the income statement must be calculated to determine the company's profit or loss. Therefore, Miss B correctly assigns this task to both the balance sheet and the income statement. We hope this video has helped you understand the topic of the difference between the balance sheet and the income statement. See you next time and have a good one.